Yeah, I guess certainly gold investors have enjoyed a very long run in the gold price, as you suggested, well over 10 years. It's not surprising that perhaps this year will be the first where we've seen the price actually put in a negative return for the year. We do think, however, when you look out longer term, say as the 3 to 5 years that you're suggesting, that there will be certainly one key factor that we'll be looking to, and that's inflation. We do think that the programs that are currently in place that many of the governments around the world have got in place, and that is to stimulate economies through various activities, will in due course in fact stimulate inflation as the velocity of money starts to increase around the globe. We do think that that will in fact be one of the key factors that will probably push the price of gold higher over the period between 3 to 5 years from now. Look, already the price of crude on the NYMEX has gone through the $95 barrel level. We do think that we won't see a price capitulation, however. Our range for the remainder of this year is a low of about $90 US a barrel. We do think that one of the key participants in the market, and that's OPEC, they will be, I guess, a balanced producer. They are at the moment producing just over their 30 million barrels ceiling, and we do think that as we've seen a surge in US domestic production coming out of their shale boom, that OPEC will be quite happy to just slowly wind their production back towards that 30 million barrel ceiling. What that will do is it will take some of the sting out of that surplus that we've seen in the US and actually perhaps drag the market back towards a more balanced demand and supply situation. So we'd have to suggest that, yes, the NYMEX crude price will breach the $95 barrel level, but we won't see it certainly probably breach the $90 barrel level for the remainder of this year. Look, when it comes to Europe, I think they're probably the easiest to deal with at this point in time. We're not expecting very much in terms of economic growth coming out of Europe through 2014. Any growth that we do see will in fact perhaps be a little bit of a bonus that could put some upward pressure on base commodity prices. We do think, however, that China will remain the key for 2014 in terms of where base prices will go for commodities. We expect that the country will continue to grow at somewhere between 7.5% to 8%. That growth may accelerate early in 2014 up towards 8% and then stabilise there. And we think that that's really the key in terms of setting price direction for 2014 for base metals. If China can continue to grow stably at between the rates that we've suggested, then it's going to still require significant quantities of commodity to generate or sustain that growth. And we think that's the key in terms of keeping prices stable for next year.